Okay, so now we're going to walk into a little more of a difficult situation where a bond is issued at a discount. For this lecture, we're going to be using the straight line method. And so some things to keep in mind when bonds are issued at a discount. And so in this example, the previous example that we had done where the bond was issued at par, now let's sort of ask ourselves, well, what if the bond was issued at 96 instead of 100? What does that imply? And so the way that bonds are priced is always as a percentage of par. And so when a bond is issued at par, it means it's issued at 100. If it's issued at 96, it means that it's issued at 96% of the par value. And so that means in this case that the bond is going to be issued at a discount. And so a couple of things just from an earlier lecture, just to remind ourselves, it must be the case then that the bond rate must be below the bond yield. And that's why it's being issued at a discount. They're not offering as much interest as the market demands. And so with the straight line method, we actually don't have to solve for the bond yield. We just know that this is inferred through the price. And so now what do they have to do? They have to record the interest payment, which is going to be a credit to cash, and they also have to amortize the discount, and that discount is also going to be a credit. And so what is that? What are the implications from that? The biggest implication is that the interest expense is now going to be derived from both the cash payment and the amortization of the discount. And so with the straight line method, since we're using a straight line to amortize the discount, and since the interest payment is fixed, it means that the interest expense will be the same in each and every period. Again, I want to be clear, the interest expense is derived from the cash payment and the method that we're using to amortize the discount. Later on, in a different lecture, we're going to be using the effective interest method. And so at that point, since we'll be amortizing the discount differently, the interest expense will also be different. All right, so this is our same example as we had done in the par bond, except for now instead of being issued at par, we're going to say that it's issued at 96, which is at a discount. And so the issue price is 96% of the par value, or $144,000. And so that initial journal entry, of course, is the cash that we receive, $144,000. The bond payable is the par value of $150,000, and then the discount on bonds payable captures the difference between the issue price and the par value of the bond. So now as we move through time, we still have that same interest payment, $5,250. Again, $150,000 times 7% times 1/2. But now we're also going to be amortizing the discount. And so the total discount is $6,000. And with a 10-year semi-annual bond, there are 20 periods, which means we'll amortize $300 each period. And so we have our journal entry. Again, just trying to be theoretically sound. We can see the cash payment is $5,250. The amortization of the discount is $300. And from that, we infer an interest expense of $5,550. Again, the interest expense is derived from both the cash payment and the amortization of the discount. We'd have the exact same journal entry at the end of the year. Again, as we mentioned before, since the amortization of the discount is constant and since the cash payment is constant, the interest expense will also be constant.